Let me welcome Rajat Sharma, who's the founder and CEO of Sana Securities. Hi, Rajat. Good to have you on the show. Help us with your reading on the markets. It's been quite a cheer in the last 1 or 2 weeks. The major event is already what we are through in terms of union budget, but upcoming RBI policy is also on its way. Help us with your reading on the markets as well as the sectors that you like at this point.
Hi, good afternoon. So, both my reading on the markets and the sectors I like have a lot to do with the events, one which has gone by and the other which you speak about, the monetary policy meet and the union budget. And, I've consistently maintained for the last few weeks that consumption as a sector was extremely undervalued. And within consumption, consumer staples, FMCG stocks is what I've liked. And with the way the income tax slab rates have been revised, obviously some value will emerge as the volume growth comes back. Although I think for a lot of these FMCG companies, the problem was not just slow volume growth on account of people not spending on the product. It was also high food price inflation, which sort of peaked out in November of 2013, where it was about 14-15%. And we're seeing a trickle effect of that coming through now. But right now, as things stand, I think a lot of the consumption stocks, the likes of Britannia, Nestle, Hindustan Unilever are available at very, very attractive valuations. And the other sector I like is banking. And, I'm hoping that there would be a rate cut in this policy. And if I look at some of the stocks that I have in this sector, I've been doing some thinking and we've been talking internally. So, for instance, HDFC Bank, one of my favorites, and the stock just had a 4% increase in net profits. If you see overall banking results, they've been fantastic this time, barring an IndusInd Bank. All the other banks have reported very, very good numbers. HDFC subdued numbers. That's because when they merged with HDFC, they took over a lot of credit and very few deposits. So, it's going to take a few more quarters for that to pan out. They're trying to grow their deposits, but rate cut would be a very good news for them. So that's one sector. So, to answer to you, in short, I'm looking at beaten down large caps which have not been performing on account of difficulties they're facing in their sectors. And to come back to FMCG, one of the stocks that reported numbers was Asian Paints. The numbers didn't look very nice, but this is the first time ever in the history of Asian Paints where you'll have I don't know, I mean, I've looked at it for the last 15, 18 years, that they've had a degrowth in sales. Otherwise, the sales have always grown 11 to 12% if you see a 10-year average. This was the first time where you'll have a negative growth in sales. And, there's plenty of reasons for that. Birla Novo and Pidilite and JSW and all these new players coming in. So overall, we looked at it, the volumes have not gone down in the paint industry if you put together all the players. But if you look at it one on one, then obviously, yeah, it looks like the sales are slowing. Be that as it may, I never liked the stock when it was trading at about 100, 105 word price and multiple 3-4 years back. But right now, very, very good time to buy this stock. It's going to take a while, a few more quarters for things to start looking good. But, we've seen this before. It happened with Colgate when Pepsodent came in. They can, increase the margin that they pay to their distributors to maintain their economic moat, their market share. And despite everything that's happened, Asian Paints today still has over 50% share in the market of paints. And the balance 50% is all these Akzo Nobel, Berger, Nerolac, Birla Opus, all of them put together. So, I'm positive that when a lot of these players have burnt their money, then things will turn back in favor of Asian Paints. So, yeah, consumption and banking are the two sectors where we're focusing right now.
All right, consumption and banking is this place to be as per Rajat, but taking a look at the markets as well. It's some of these PSU names that are doing pretty well today, a case in point being Coal India, BEL, as well as even a while back, Power Grid was also holding on. Kunal, any take on Coal India? Because off late, we have seen this stock definitely quite volatile, but it seemed to be recovering from the lowest point.
it's recovering, but there's nothing major on the charts for Coal India. The stock is still just about very sideways. Only good part about the stock so far in the last 2 weeks that it had stopped falling, and over the last 2 weeks the stock had stopped making lower lows for itself. The first low with the stock had made at the start of the month of January was just about I think closer to 360-61 levels, and post that we've actually seen marginal higher lows for the stock. The recent one being just around the 367-368 mark for Coal India, and the range or the resistance on the upside is just about that 400 levels, which means broadly it's trading into this 30 to 40 point band, and I don't see any major breakout levels unless the stock breaks past over that 400 resistance.
Rajat, you did talk about preference towards banks as well as the consumption plays, but what about the capex theme? Do you think that's not a space that will make money for, say, the next 6 months to 1 year?
Capex companies are like, when I look at capex, I look at only the large caps. Most of the capital expenditure companies are available at extremely, extremely high valuations. So I've not spotted anything there for the last 3-4 years where I can say, yeah, this is one stock that, you could buy and hold into your portfolio. Anyways, there would be, going by the economic survey and the budget speech itself, there could be some slowdown in capex spending compared to the rate at which the government has been doing capex in the last few years. That combined with overall valuations in the sector, I don't think it's a very, very good, if you follow a top-down approach, it's a very good place to be.
Right, but moving on, coming tomorrow, there are 6 nifty companies coming out with the earnings. So let's start telling you what is the street penciling in. And let's start with SBI then. It's all set to report its numbers, but what is the expectation? Let's go across to Gaurav to find out all those details. Take it away, Gaurav.
Well, yes, the biggest bank of India, SBI, is going to come up with the numbers, and when it comes to expectation, people are expecting higher than industry growth when it comes to loan book, and at the same time, net interest margin and asset quality is also likely to stay stable, and that is the reason why they're expecting good set of numbers from SBI. So first, let's look at the numbers. Advances are likely to grow almost at 14%, while deposit growth could be at around 11%. Now, low deposit growth can actually not be a constraint in advances growth because of the low CD ratio, and as a result, when we talk about net interest income, that can increase almost by 7%. Now, let's not forget that global yields are rising, and that is the reason we may see some pressure in net interest margins. Now, Street is expecting around 2 basis point fall in net interest margin marginally, and as a result, when we talk about PPOP, some lower staff expenses, something which can aid the PPOP growth to be around 29% on a year-on-year basis. Lastly, when we talk about the asset quality, they are not expecting any kind of stress in asset quality. In fact, asset quality is likely to stay stable, with credit cost also stabilizing at around 0.5%, and as a result, when we talk about profitability, it is expected to grow at around 77% on a year-on-year basis. Now, let's not forget that last year in the same quarter, we have seen some impact of wage rate revision, and that is the reason why these numbers may look elevated, but overall, good set of number is what Street is expecting from SBI. When we talk about some of the commentary, now Street will be looking at the commentary in terms of slippages, how much of slippages were contributed because of the agri book, because Q3 is usually weaker for agri book. Other than that, any kind of commentary on ROA and how is it going to be, any kind of commentary on the movement of net interest margin is also going to be a key thing to watch out for. And lastly, any kind of commentary on raising capital, if SBI is looking to raise capital, is also something which can be expected from the management. But overall, good set of number is what we're expecting from SBI in third quarter.
Expectation coming in from SBI, but Swiggy is also, set to report its numbers today itself. Let me take it across to Snehi and find out what the ET Now poll is penciling in.
Well, absolutely. Overall, we're expecting a muted set of numbers for Swiggy on a consolidated sequential basis. Revenue is expected to grow by 11.6% at 4,019 crores. EBITDA loss is expected to widen this time around at 535 crores compared to 511 crores, which is down 4.5% on a sequential basis. Lastly, the net loss is expected to contract slightly, but not much improvement on that front, because last quarter this number was at 625.5 crores and now we're seeing this at 620 crores. So not much of an improvement when it comes to the shrinkage of the net loss coming in for the company. Now, key expectations: food delivery is expected to post a 6% sequential GOV growth, and food delivery take rate is expected to be at 22% sequentially. Quick commerce business, which is their Instamart business, to post 16% sequential growth, and the take rate for the same will be at 14%. 2.2%. Instamart is projected to report a negative 2.2% contribution margin, so that is a point of worry. On the flip side, out-of-home consumption is anticipated to reach break-even by 19.3% sequentially. That's a positive coming in for their dine-out business. Overall, when the numbers come out, any commentary on market share, the monthly transacting users, the expansion in the platform fee, if they have undertaken any EBITDA margin, the number coming in that front, and the net store expansion for Instamart is going to be in focus when the numbers come out. But overall, a muted set is what we're expecting.
All right, Snehi, but hang on, it's going to be a busy day for you. So Swiggy is today, but coming tomorrow, we do have numbers trickling in from Britannia as well as ITC. Help us with the estimates on both of these companies, Snehi.
Well, yes, we were expecting an okayish set of numbers for Britannia for Q3, because while we're expecting the revenue to go up, all of these three other operational metrics are expected to inch down on a year-on-year basis. On a consolidated basis, revenue is seen at 4,507 crores, which is up 6% on a year-on-year basis. However, EBITDA is expected to come lower by roughly 6 to 6.5% at 769 crores compared to 821 crores on a year-on-year basis. Net profit is seen at 517 crores compared to 556 crores, which is down 7% year-on-year. Margins are also expected to be under pressure at 17% compared to 19.3%. Here are some key expectations that we have with Britannia's numbers. EBITDA and margins are expected to contract year-on-year on the back of raw material inflation as well as adverse operating leverage. There's a 5% year-on-year volume growth that's expected in biscuits. Remember, this in Q1 and Q2 was at 8%, and this time last year this growth had come in at 5.5%. This time this growth is expected to be lower, impacted by price hikes and subdued consumption environment. The company has taken a 2 to 3% price hike in some of its products during the quarter to offset some commodity price inflation, and some brokerages are estimating a pricing growth of roughly 1% on the back of this. Key monitorables to watch out for when Britannia reports its numbers: the demand outlook, the progress of new ventures like the cheese business, raw material scenario, pricing action, as well as commentary on rural versus urban demand. So watch out for all of these factors. But well, yes, overall we're expecting a very okayish set of numbers from Britannia this time around. Well, yes, overall we're expecting a rather decent set of numbers from ITC. Nothing great is expected this time around, because if you take a look at the standalone revenue, that's expected to come in at 18,456 crores compared to 16,483 crores, which is an uptick of 12% on a year-on-year basis. EBITDA is expected to go up by 6.5% at 6,402 crores. Net profit, however, we're penciling in some pressure over here, down 5% on a year-on-year basis. We're seeing this figure at 5,290 crores compared to 5,572 crores on a year-on-year basis. On the back of this, margins are also expected to contract slightly at 34.7% compared to 36.5% this time last year. Some key expectations: a cigarette business volume is expected to grow anywhere between 3.5% to 5%, and sales growth of 7% year-on-year is expected in cigarettes. The FMCG business is expected to grow by 5%. Now, margin pressure is likely to persist due to inflation in leaf tobacco and agri commodities, and high growth in agriculture business, which is also a low margin business. The paper segment is expected to remain weak and expect muted performance here. Just an uptick of 2% on a year-on-year basis in terms of sales revenue, rather, is what we're expecting in terms of the paper business. Agriculture segment and hotels are expected to do well this time around. What to watch out for when the numbers come out: demand outlook on rural versus urban, the competitive intensity, company's outlook on raw material trends, the agri-business outlook, as well as the pricing strategy are going to be key to watch out for. But well, yes, overall we're not expecting any surprises, but well, yes, a rather decent set of numbers from ITC this time around.
Well, lots of numbers, and Trent as well is also, set to report its quarterly numbers as well. Jinay is here to tell us what the poll is penciling in.
Well, as Trent is all set to report its number. If you look at the overall standalone basis, the revenue is expected to come up higher, 40%, coming in at 4,620 levels. The EBITDA level is also expected to surge by 38%, coming in around at 860 levels. The margins are, however, expected to be moderated around the similar levels of 18.6%. And the net profit that is expected to surge more than 50%, coming in at 520 crores year-on-year basis. Overall, analysts believe that the revenue growth will be driven by mid to single-digit SSSG growth, as well as the store expansion of the company. For the fashion portfolio in particularly, they're expecting around a 12% like-for-like growth year-on-year basis. Also, apart from these other factors that will be watch out for Trent will be the demand outlook for metros and tier 2, tier 3 cities. If you remember, Trent has been consecutively telling that the demand outlook has been muted for last couple of quarters, and also the store expansion strategy going ahead will be a key watch out factor for Trent.
All eyes on Trent, but let's also talk about the telecom major Bharti Airtel. What's the street penciling in? Let's go across to Ansh to find out all those details. Ansh.
Well, the expectations are strong. Revenue is expected to rise by around 6% to 43,955 crore, whereas EBITDA is seen increasing at 6.6% to 23,290 crore, with margin improving to 53%. Now, if we talk about net profit, then that is likely to jump by more than 45% to 5,270 crore, whereas subscriber base is expected to increase by 30 lakh users, reaching 35.46 crore users. ARPU is projected to rise by around 6.5% to 248 rupees, and this would be mainly fueled by July tariff hike. Now, if we talk about segmental growth, then we are seeing that mobile service revenue is expected to grow by more than 4% on quarter-on-quarter basis, whereas home broadband revenue could rise by around 7%, and enterprise business is likely to remain flat. If we talk about factors to watch, then first would be progress on 5G implementation. Apart from this, capex, future tariff hike, and market share shift any.
All right, but talking of tomorrow, all eyes will be on Hero MotoCorp as well. This time we are not expecting much or not a great set of numbers rather from the company. Why so? Because this has been a key underperformer in terms of the volume growth. Because on a YOY basis, though the volume has been quite flat, but sequentially there has been a single-digit growth versus the single-digit decline versus a growth number that what we have seen in rest of the two-wheeler majors. And if you will see, the volume growth was actually less than what even the management was expecting. Other than that, due to the average selling price increase, there has been some inch up in the realization is what we are expecting. So all in all, on the number front, sequentially, there could be a 50 basis point of decline is what we are expecting, but holding strong at 14% margin is what we are expecting. Other than that, just a single-digit growth number in terms of the profit, revenue and EBITDA number of the company. The management commentary will be the key to watch out for because they have been quite bullish about the rural growth. So how is that panning out for the company is something that we'll be watching out for. Their long-term margin guidance of 14 to 16%. Are they making any tweaks to that, any changes to that? We will have our eyes on, and especially on the ICE margin as well, because last time the excitement was a lot about the ICE margin holding strong at 16.5%. This time, how the numbers pan out, we will be watching out for that. But definitely, there's been a lot of pressure on the stock price as well, because from those September highs, the stock is now down about 31%. So let's see how the numbers come out. Margin will be the key to watch out for.
Okay, lots to look out for when it comes to lots of earnings which are bunched up now. But let's get in some BTST trades going as well. Naresh, what's on your list?
So that would be about Reliance Industries. The stock is forming a base and setting up for a move. Stop loss at 1265, target price of 1310. Second is about IEX. The stock has given a short-term breakout today. Stop loss at 177, target price of 186.
Kunal, what about your strategies?
I'll go with two differentiated names. First is about Edelweiss. That's a chart which is looking attractive. Look out for targets in the range of 124, stop loss at 110. And the second is about RBL Bank. That's a chart which is given a breakout about that 170 mark. So look out for targets in the range of 180, stop loss at 165.
All right, with this, it's time to wrap today's trading session. Thank you so much, Kunal, Naresh, as well as Rajat for taking the time out and speaking with us.